In this presentation, we're going to enter reversing entries related to the current and long-term portion of the notes payable. In other words, we entered an adjusting entry prior to this to make things correct as of the cutoff date related to the short-term and long-term portion of the loan. We're going to do reversing entries to bring things to a logistical point, which is going to be as easy as possible for the normal day-to-day type of journal entries related to the notes payable. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to be opening up the balance sheet by going to the accounting dropdown and then open up the old balance sheet. We're then going to duplicate the tab by going to that tab, right-clicking on it and duplicating it. Next, we'll change the dates to our cutoff date, and that's going to be the end of February. So there we are, February 29th. Now, last time what we did with regards to the loans is we broke out the loans as of the cutoff date. We want to make it presentation-wise as correct as possible with relation to like generally accepted accounting principles as of the cutoff date. And to do that, in our liabilities, we took the two loans that we had and we put them into the short-term and long-term portion. So the short-term portion up here, long-term portion down below. Now that works well. I mean, we have to do that to report the short-term and long-term portion correctly. However, it's not that good for logistical purposes because it doesn't allow us to have one loan account for some of the loans. We had to break them up into two, and the interest and principal portions are all different. So that kind of messes up the whole purpose of us having one account that we could kind of tie into the amortization table. So what I'd like to do is only do that periodically and then reverse that back out so we only have all one section of loans down here, one loan. I would like one loan account per loan and actually reference the loan number and everything next to it. So what I'm going to do then is enter reversing entries, and this is what we do to kind of match up between the adjusting entries and the reversing or the normal accounting department. So the normal accounting department, we think logistically we want to enter things as easy as possible and then plan for adjustments that if need be to be reversed, then we reverse them at the end of the period. So we're going to reverse this, and what's going to happen then is we'll go back to where we were before, meaning we'll have two accounts down below, and we'll remove kind of these short-term current portion accounts. There's two journal entries we need to reverse in order to do that. They look like this. These are the two journal entries we entered last time. So we're simply going to take these and reverse them exactly. So I'm going to go back over and say that to do that, let's go back over to the first tab. And notice the reversing entries are all going to be there as of the first day of the next month. So as of March 1st. So we want things to be correct or on an accounting standpoint as of the first day of the next month. Accounting dropdown, we're then going to go down to the reports. We'll go on down to the journal reports. So we got to go into the journal reports so that we can get into the journal entries. Then I'm going to go to the add new journal. So then we're going to add a new journal. Now this is going to be a reversing entry instead of an adjusting entry. So reversing entry, and instead of the cutoff date as of the end of February, we are going to be in the first day of March. So first day of March, the day after the cutoff period. All right, so reversing entry, and I'll bring this a little bit larger so we can see this. And then I'm just going to reverse, these transactions exactly. So the first one, I'm going to say was account 2615. It doesn't let me just pick up the account, like that's funny. Notes payable. I'm just getting picky, I guess. Payable, and this is going to be the 7642. And we debited it last time, so now we're going to credit it. So I'm just reversing this first entry. I'm just reversing this entry. So I'm going to say, all right, we're going to credit it. Now I'm going to put the credit on top. It's easier for me to do that, to just reverse it. The accounts in the same order and the credit on top. Some people, want the debit on top. So, but don't worry about it. It'll report the same way. I would do it whatever way makes the most sense for you to construct the journal entry and then go back and look at it. So the next one's going to be the notes payable. And this is the current portion, notes payable current portion. And there's the 50,000 there. So that's going to reverse the first one. That'll reverse this one. Let's make another one and reverse the second one down here. So I'm going to say, all right, let's save that one. And I'm going to post it. And then we're going to do it again. I'm going to add another one this time. We're going to do two at a time here because we're crazy like that. This is going to be a reversing entry. And then this is going to be for the first day of March again, so March 1st. And then reverse an entry in the description. We're going to now be reversing note payable, no S, and for that 34558. And this is going to be a credit for the 13109, putting it back into basically the long-term portion. And then the notes payable current portion is going to be the debit. So we'll reverse those two. Let's go ahead and post that and see what happens. And we're going to go back to the balance sheet. And if I update as of the cutoff date, no change. We didn't enter this as of the cutoff date. That means everything is the way we want it as of the cutoff date, breaking out the current and long-term portion. Once we go to the next day, the first day of the next time period that we'll be working with, then we'll have this notes payable having two notes payable down here. This one should disappear. So let's go back up top and we're going to say, let's do this as of March 1st and then update that. And then we're going to scroll back down and see what happens. So March 1st. So the current portion is now gone. And we're back to having our two notes payable on the books. And now we can go back and next time we make a payment on these notes, we could simply tie them out to, say, the amortization table as we see here. So the next time I make a payment, I want to be able to tie the loan balance out to this balance. And I can't really do that very easily if you have the short-term and long-term portion within there. So now I'm just going to track each loan by itself, not have a short-term and long-term portion for it, and be able to track the actual loan numbers with it from a logistical standpoint. Then we'll make those periodic adjustments at the end of the time period to make the financial statements as they need to be at that periodic period, the end of the month and or end of the year. That's it for now. Let's get out of here.